With that, we'll start the presentation. So again, today we're going to be looking at the FERS overview and go over the FERS retirement system. So we'll start with the background, which the first system was the Civil Service Retirement System, CSRS, that started in 1920, and it was through 12/31/83. So this was all employees that were covered in a covered position were under CSRS unless it was specifically excluded by law or regulation. And then on January 1st, 1984, that is when Social Security Amendment Act of 83 went into effect. And so basically what had to happen now were potentially all new employees had to be covered by Social Security. So through this 2-year period, which we see here as CSRS interim, that was from January 1st, 84 to 12/31/86, was kind of the period where they had to create FERS, because they knew, as of the Social Security Act, that federal employees were going to start being covered by Social Security. We know under CSRS, they do not pay into Social Security. So they had to come up with this plan. And so for this interim period, they were not placed into FERS or just CSRS. And then on January 1, 1987, when FERS was created, they had to make determinations to see if an individual would be placed under FERS, if they would stay in CSRS, or potentially go into CSRS offset, which CSRS offset also was created on January 1st, 1987. So that's a little bit of the background. And so then again, like I just mentioned, the Federal Employees Retirement System Act became effective on January 1st, 1987. And all new employees, if they had no prior federal service, were placed into this system, unless, of course, they were excluded by a law or regulation. And so what we're going to do now is we're going to look at some of the exclusions by law and regulation. And so this can all be found in Section 8401, 11, and 8402 of Title V, the U.S. Code. It's also in our Chapter 10, the CSRS and FERS Handbook, which was recently updated last year, I believe. So the big one is individuals that are ineligible for Social Security coverage cannot be covered by FERS. So this is generally, an example would be a non-resident alien that could not participate in Social Security could not be covered by FERS. The other is if they are subject to another government retirement system. So that could be the Tennessee Valley Authority system, foreign service, are just two examples of other government systems that they could not also be under FERS unless they waive their rights to that other retirement system and move it to, and if they can, move the deductions to under FERS. Some other exclusions are U.S. judges appointed for life, certain temporary employees of the Administrative Office of the U.S. Courts, as well as certain employees of the Architect Capitol, Library of Congress, Botanic Garden, as well as the House and the Senate. For a complete listing, this is also in Section 8402, 2, 3, 4, and 5 of Title V of Code of Federal U.S. Code. And then finally, exclusions by law are D.C. government employees. There are, of course, some exceptions to this rule, and that's non-judicial employees of D.C. government. Generally, non-judicial are all employees except justices, judges, and the executive officers of court. And these are generally employees first hired by the district after 10/1/87 by agencies with the authority to hire deemed federal employees. And this so also the period the non-judicial employees of DC courts began receiving FERS service as well later on. Then it was just at 10/1/1997 that they became all federal employees. And now we've got the exclusions by regulation. So this is much smaller than CSRS, and this can be found in Section 842-105 of 5 Code of Federal Regulations, or Chapter 10 of the CSRS and FERS Handbook. And that's appointments limited to 1 year or less, or intermittent employees serving under other than career or career conditional appointments, And one of the big differences between FERS and SERS is the term appointments. Term appointments are excluded by regulation under SERS, not FERS. And that's what caused a lot of employees being misplaced in the wrong system, kind of as FERS came into being, because it was so used to term appointments not being covered. But again, they are covered by FERS. And of course, there is an exception to this, and that is the continuity of coverage. So there are no exceptions to these exclusions by law unless it's a statutory exception. However, when an employee moves from a retirement-covered position to one that is normally excluded by regulation with a break in service of 3 days or less, they will retain their prior coverage. And again, so we just looked at the prior slide, those are exclusions by regulations. So an example would be an individual was covered under a career conditional appointment. They separated, let's say today, August 11th, 2020. As long as they were to pick up a temporary appointment 3 days or less later, so let's say August 14th, they would still retain their FERS coverage because of the continuity of coverage rule. Look, sorry, I'm just pulling up chat to make sure I didn't miss any potential questions. Okay. And so now another factor that came into play was the FERS revised annuity employee system. And this was from Public Law 112/96, Section 5001, the Middle Class Tax Relief Job Creation Act of 2012. There are two big changes for FERS. And the first one is beginning on January 1st of 2013, all new employees pay 3.1% of their salary as FERS retirement contribution instead of the 0.8%, which had been the requirement under FERS. And also new employees of Congress and congressional employees now also pay the 3.1%, and they accrue benefits at the same rate as a regular FERS employee. But prior to that, and members of Congress and their staff, if they're still working, they have the higher percentage, which is the 1.7% of their high three average salary versus 1% or the potential 1.1%. But now for any new members, their benefits are computed as at the normal FERS rate. And of course, like we'll see with everything with FERS, there are some exceptions. That is, on 12/31 of 2012, if you're already covered under FERS, you would keep the, again, FERS, the 0.8% deductions. It would not go up to the 3.1%. And then on 12/31/2012 as well, an individual was performing civilian service, which is creditable or potentially creditable under FERS, would keep the 0.8% deductions as well. And finally, the individual on 12/31/2012 was not covered under FERS, and it was not performing civilian service, but they had potentially creditable service under FERS as of 12/31, had at least 5 years of creditable service, whether it be subject to SERS or SERS offset. They would also not be excluded, or they would not have the increase in contributions. And again, a BAL was published from our office, BAL 12/104, that covers all of this in greater detail. And then on the following year, we had the FERS Further Revised Annuity Employee, which is FERS FRAE. And this was Section 401 of the Bipartisan Act of 2013 that states employees that are hired 12/31 after 12/31/2013, so 1/1/14, who are not excluded from FERS coverage became subject to FERS FRAE. That is the same for members of Congress and their employees pay 4.4% of their salary towards FERS retirement contributions instead of 0.8 or 3.1%. This is covered in BAL 13/102. And so I do want to add that in Chapter 10, the SERS and FERS handbook that was recently updated, we do have new hire, rehire, transfer, and conversion charts that include all of these new steps for FERS, FERS Re, and FERS FRE. Another big thing that I want to touch on is that we do often get a lot of questions of if someone was put into FERS but should have been in FERS Re or even FERS FRE, if that is a FERCA error. And currently at this time, as the law states, it is not a FERCA error. It will just be either a salary overpayment or a salary underpayment, depending on the system that they were put in. So if they were put in FERS FRE and should have been in FERS 0.8 deduction, that would be a salary underpayment. Whereas if flipped, it would be an overpayment. And again, at this time, it's not considered a FERCA. It's possible in the future. It could be. It's just still so close that the overpayment can be very large, but not like what I guess they were seeing when FERCA was initially enacted. But again, it is not a FERCA issue right now. And so along with FERS, we're going to look at the type of retirements. And these are the voluntary, which is the standard MRA in 30, 60-20, or the age 62 and 5 years. That falls under the voluntary. The early voluntary retirement is generally if an agency has an early out or a major rift, as well as discontinued service, fall under the early voluntary retirement, which is the age 50 with 20 years of service or any age of 25 years of service. We also have disability, which is 18 months of service under FERS appointments. Special provisions are the law enforcement, firefighter, officers. Yes, FERS FRE does include term appointments. So again, it's not changing any of the exclusions by law or regulations for FERS. Everything else is still the same, as well as as we get down into it a little later in the presentation, the computation of the annuity. The only difference between FERS Re, and FERS FRE is the deductions that are withheld. That's the only difference. So that a newer employee will be paying more into their FERS retirement than someone that started prior to January 1st, 2013. And then finally, the deferred retirement, which that's the 62 and 5, or the MRA plus 10, which can be postponed if the individual chooses. So here we've got the requirements for the voluntary, which I just briefly mentioned, which is the MRA and 30 years of service, age 60 with 20 years of service, age 62 and 5 years, or the MRA and 10, which again is voluntary. And if it's MRA and 10 is taken, there will be a reduction in annuity. And here we have the chart for the minimum retirement age. So it starts at 55 and goes all the way up. It's capped at currently 57. So the chart there, prior to 1948 and up to, I guess 1948 is 55, and it goes up to 55, 2 months each year until 1953 to 1964. It is 56 for that period of time, and then it goes up slowly until 1970, which is now 57 and after. And then the early voluntary retirement, again, is any age 25 years of service or age 50 with 20 years of service. And again, these are normally for when an agency is undergoing a major rift, major reorganization, or a major transfer of functions, or as well as a discontinued service retirement. Again, the early retirement authority, which is needed on the 3107-1, or again, the involuntary separation, as long as it's not for misconduct or delinquency. And this is also covered in the Chapter 44 of the discontinued service of the SERS and FERS handbook. And with a disability, again, that is 18 months of creditable civilian FERS service. They must have that minimum requirement to go out under disability. And we'll get into a little more later, but the disability is generally the first year, it's 60% of their high 3 average salary. And then the following years until they hit their age 62 would be 40%. Of course, then this is also 50% and 40% is offset by any Social Security that they are awarded. And these special provisions, again, this is the law enforcement officers, firefighters, congressional employees prior to employees and staff and members prior to 1113 is 50 years old, 20 years of service, or any age with 25 years of credible service. And with these special provisions, the high 3 salary is then multiplied by 1.7%, but it's capped at 20 years of that service. So anything after that would then be 1%. And then the aid in service, the deferred, that is the 62 years old with 5 years, or the MRA with 10 years of service, which they can take immediately, or they can postpone it until 62, which would reduce with the reduction for the MRA plus 10. And now we're going to look at the selecting a retirement date for under FERS. It's pretty straightforward in FERS, and it's just generally you're on the last day of the month because the annuity won't start until the first day of the following month. So again, it's more beneficial. Of course, they could retire in the middle of the month if they chose. Just they will be waiting potentially 2 to 3 weeks before they start receiving annuity. There are, of course, a few exceptions for this, and that is for FERS retirements, a discontinued service annuity commences on the date after separation only when the retired is at least age 50 with at least 20 years of service, or is any age with at least 25 years of service. General early outs, they start the first day of the month following separation. And disability, the annuity commences the day after separation from service or the last day of pay, depending on which one is more beneficial to the disability annuitant. Okay, now we're going to look at crediting service. And so with federal civilian service is normally credited from the beginning to the end point. The few exceptions are leave without pay, which an individual has 6 months of leave without pay in a calendar year before it starts to impact their service. So if someone was out a full year, they would receive 6 months credit, so from January 1 of the year and credit would stop July 1st of that year. However, of course, if they have less than 6 months of paid leave without pay in a year, they would get credit for the full year. The other exception is when actually employed. That's the intermittent, and is when they only get credit for the days or hours worked. And then the seasonal WAE, which isn't as common anymore, although I guess the census is going on now, so I'm sure they have seasonal WAE employees for the census. You generally see that with census employees and post office during Christmas time. So another thing is you can credit military service in your FERS annuity. Of course, there are a few rules for that, and that has to be honorable active duty service. And I guess at this time now, 2020, most people, their military service will be post 56, so they will have to pay deposit to receive credit for that. And the deposit equals 3% of the base pay plus any interest. And also another factor in this is the military retired pay. So generally, if an individual is receiving military retired pay, they cannot then also receive credit in their FERS annuity unless they waive their military retired pay or they fall under one of the exceptions to that rule, which is if an individual is receiving military retired pay on account of a service-connected disability incurred in combat with an enemy of the United States, or the other is for the retired reserve members, and that's under Chapter 1223 for members of the reserve, that they can receive their military retired pay and have it included in their FERS annuity. And they will still have to make a deposit for that as well. And so crediting the uncharacterized, they would need to get that, send it back to the branch to have it characterized. My understanding is that is would not fall under honorable for retirement purposes. So they would have to go back to their whether Army, Navy, Marines, and request that their DD-214 be updated to characterize whether it be honorable under honorable conditions or worst case if it is dishonorable. They will have to get that updated. And with the military deposits, again, it's equal to 3% of their base pay. And also, I do want to mention the full payment must be made to the agency prior to separation. Now, I know we did just put a BAL out 2017. That's BAL 17101, and that's the Military Administration Error BAL. And that's if an employee, through no fault of their own, were miscounseled or not told that they could make that deposit, and have to follow the steps in the BAL. Yes, it's 17-101, and have to follow that steps. They would have to waive their retired pay, ideally as close to retirement as possible, so there's not a lag time. So I guess going back a few years when I was case processing, generally what will happen is if it's sent to the military office, if it's DFAS, sorry, it can take a few months, so that would delay the processing of the annuity. So it's best if, again, I know it's tough because obviously they don't want to gap in pay, but the sooner the better is the best answer, I guess. We've got another question. We've run into a lot of questions about active duty orders in lieu of a DD-214. Can you provide clarification on if and when orders are acceptable? It really depends. Generally, we say, obviously we want the DD-214. I can't really give just a blanket because it depends. We need the documentation to show the dates of active duty, the discharge, the character of discharge, and another big thing is time lost, if there's no time lost. And sorry, if you could please mute your phone. And then, time lost, as well as ideally also if it's Title 10, Title 32. So if it has all of that documentation, we should be able to use that in lieu of the DD-214. Generally, we do want the member for copy because that does show the character of discharge. I know some of the DD-214s don't have that bottom section that shows character of discharge and, again, time loss or anything like that. So, again, if the copy has all of that, we should be able to accept it. But it's just those key components that we need, or else if not, we will most likely reach back out to the agency or have the employee try and get that information from the Military Records Center. See, and to that, unfortunately, I can't say for certain without seeing them why some were accepted and why some weren't. It's possible maybe there was, I don't know if there's accompanying documentation or if it was an error on OPM's part. Yes, character of discharge is very important because we need to know whether it was honorable or not. So we really do need that information. And so back to the BAL 17101. So that is, it goes over the guidelines, what's needed. Generally, that's sent to OPM, and we will make the determination if the employee / retiree at that point can make a belated military deposit to their former agency. And it would go to the former agency. It's not paid to OPM. So the question is, are you able to receive a FERS annuity and military retirement simultaneously? Yes, that would not have, if they're receiving military retired pay, they don't credit it to their FERS annuity, but they're still eligible for annuity supplement. Yes, they would still receive their annuity supplement. And again, with the military deposit, it's equal to 3% of base pay plus any interest. And so there is essentially, if they make the payment within their the employee can avoid paying some or all of their interest if it's paid in full within the first 3 years of being hired or rehired or from the military, depending on when the military service occurs. Because there's the 2 years where the interest does not accrue, and then they have 1 additional year. Well, interest will start accruing, but if it's paid before the interest accrual date, they will not owe any additional interest. Again, that's covered in the Chapter 21. Is it required to have a separate DD-14 for total prior active service? I guess, is that question, do you mean they've got multiple periods of military service? I guess we wouldn't need, I'm just trying to understand the question. I guess there wouldn't be one total one if, say, they had a period from, let's say, 94 to 96, and then another one in, say, 2001 to 2004. We wouldn't need one covering all those periods since they were separate. We would just need a DD-214 for each period of service. And so with that, we'll now look at the civilian service deposits. And that is pretty straightforward under FERS. It's FERS non-deduction service performed prior to 1/1/89. As long as the deposit is paid in full, they can receive credit towards annuity eligibility, retirement eligibility, and the annuity computation. If it's not paid, they do not get credit for retirement eligibility or in the calculation of the annuity. Generally, again, with FERS, there's always the exceptions. Some service after 1/1/89 may be credited. A few examples are service performed as a Senate employee child care worker, as a volunteer in the Peace Corps, and also service performed under a Federal Reserve Bank plan. And again, these are some of the exceptions where the credit, they may receive credit after that 1/1/89. And the deposits, they are equal to 1.3% of earning plus interest. And then FERS refunded service, prior to the National Defense Authorization Act of 2010, the effective date for that was 10/28/09. FERS employees could not buy back their refunded service. But this law, also known as Public Law 111/84, Section 1904, permits individuals that are subsequently reemployed to make a redeposit of the refunded service plus interest, and to have the credit service receive credit in their annuity. This is also allowed for survivor annuities. Redeposits may be made by survivors. And so with this, with the FERS refunded service, if the deposit is paid, it allows the credit for the employee's retirement eligibility as well as computation in the retirement annuity. If the redeposit is not paid, the service may be used for retirement eligibility, but it cannot be credited for the computation of the annuity. And also another thing with that National Defense Act of 2010 was it allowed sick leave to be credited in FERS annuity computation. And this was effective for retirements 10/28/09 and later. And so individuals at that point retiring received 50% of their unused sick leave credits. And then on January 1st, 2014, FERS retirees receive their full unused sick leave credit in retirement. And again, sick leave, it's not creditable for establishing retirement to the annuity eligibility, but it will increase the annuity computation. So this is just an example of a FERS retirement with a FERS component and the frozen sick leave and how it works. So basically, 100% of the sick leave at the time of the FERS election, the frozen sick leave, is added to the FERS portion. And then the difference between the total sick leave at retirement and the frozen sick leave is calculated in the FERS portion of the annuity. So an example would be if an individual had 500 sick leave hours under FERS and they transferred to FERS, that 500 would go towards the FERS computation. And then let's say at the time of retirement, they had 1,000 sick leave hours. That 500 would be under the FERS portion, and the remaining 500 would then go into the FERS calculation. And then, of course, they would be the FERS and FERS component portions would be added together to get the full annuity. So now we're going to look at the salary side and then ultimately the full annuity calculation. So the basic FERS annuity is based on the percentage of the high 3 average salary, which we'll get into. It's then times 1% or 1.1% for just a standard retirement. And the percentage is determined by the amount of the creditable service and the appropriate annuity formula. So then, again, the differences between the standard and we'll say, for example, the special provisions, law enforcement, firefighters, they have that higher rate. So the high 3 average salary, it is the high 3 average salary is the highest pay obtained by averaging the rates of basic pay in effect during any 3 consecutive years of service, with each rate weighted by the time it was in effect. And again, this does not have to, generally it's at the end of a person's career, but of course it doesn't have to be. The main thing is that it is 3 consecutive years. There can also be a gap. So if someone, part of their high 3 average salary was, say, an appointment from 2013 to 2014, they left federal government for a year and came back in 2016, and 2016, 2017 was the rest, that high 3 average salary. It is consecutive, even though there's a gap from 2014 to 2015. That could still be used. That generally is already included. Now, there is the cap on the law enforcement pay, and it's the GS 15 step 10 rate, or the executive schedule 5 table, I believe, is the cap. So if the leap takes them over that cap, they're still stuck at that cap of the GS 15 step 10 for retirement purposes. It can't go higher than that. I know there's been some, with the new legislation, there's been some talk of that. I haven't been able to go through all of it, but it's possible that could be raised, because I think from the CARES Act, I think it did allow certain individuals to go over that pay cap, essentially. Some other things to mention for the high 3 average salary is that a break of 3 calendar days. Yes, the CARE Act that came out, it did do some. It covered a lot of it. The sick leave, the 2-week sick period. I know that is different than normal sick leave because it's not basic pay. However, I do know that we are in the process of publishing a BAL to cover the broader act was the CARE Act. There are subsequent sections in that, and we are in the process of putting on a BAL that's going to how it affects retirement annuity. And I know the big one was that sick leave 2-week period. Since it's not basic pay, how would it or would it not affect any retirement? And it will. Short answer is no, it will not. almost essentially like a 2-week freebie, because it's not going to harm an individual if, for example, that 2-week was in their high 3 average salary. It won't, just the salary that is in place would be used for those period. I guess they wouldn't be charged leave without pay for that 2-week period, essentially. And speaking of leave without pay, again, if an individual has leave without pay in their high 3 average salary, if it's 6 months or less, it will not impact the high 3 average salary. If it's more than 6 months, the average salary may have to go back earlier than 3 years to get a full 3 years, which could then potentially lower the high 3 average salary. And also, military pay will not be used in computing the high 3 average salary unless the military service interrupts the civilian service and the employee exercises their USERA rights. Then it may be treated as civilian pay in the high 3. Yeah, so an example would be if someone had it's more to it doesn't have to be continuous, but it has to be consecutive. So if they are, they worked from 2012 to 2013, I think was the example, and then 2013 to 2014, and they left federal service 2014 through 2015 and came back beginning of 2015 and then had enough years to retire 2017. And the high 3 was the last 3 years. So you could use the 2013 to 2014 and then 2015 to 2017 because it's consecutive, even though there is a break in there. Essentially, is that high 3 has to be consecutive years, but it doesn't have to be continuous. OWC is a little, that can be a little tricky because they are still on the rolls. And there are some enhanced OBC benefits. I will, if you ask me that again at the end, because I know it's talked about I'm playing on the chapter, I think it's chapter 102 maybe, that covers OWCP and how it affects FERS. But I don't think it does, because generally they can receive the OWCP enhancement, which it essentially was created to not impact an individual's retirement, because while they're on that workers' compensation, they are still on the rolls, but they are not able to TSP matching, things like that, because they're not getting paid. So there are some rules that were created to help an individual on workers' compensation. Yes, there are. We're actually on the next slide here. We talk about what's included in basic pay. And so what is included in basic pay is the regular pay, the locality, any night differential for wage employees. We often refer to it as APFs. And then that premium pay, the leap pay for FERS firefighters and law enforcement. Again, there is, like I just mentioned, that cap that they can't go over, that GS 15 to 10, or the I think it's Executive 5 table. And generally, you'll see that information on the SF50. Now, here's what's not included in basic pay, and that's bonuses, overtime, allowances, special pay for recruitment and retention purposes. And we do have more examples of what's not included. It's in Chapter 30 of the Service and FERS Handbook. It goes over what else is not included in basic pay. And so now we've got the general formula. And this is just if the person is under age 62 or 62 and older with less than 20 years, it's 1% times the years of service. No, they do not. My understanding is that they do not get that 1.1% calculation. That's on the next two slides. We'll go more into that. But basically, the general formula is used to compute the basic annuities for voluntary, early retirement, early outs, discontinued services, and deferred annuities. It's also used for disability annuitants once they're over age 62 and if their disability is recomputed. And also, there is no maximum annuity under FERS, like there is that maximum FERS annuity, which is the 41 years and 11 months of service. So here's just a quick example of FERS calculations. Employees age 56 with 35 years of service, and the high 3 average salary is $75,000. So 1% of $75,000 is $750 times 35 for the 35 years of service is $26,250 for the year, then divided by 12 for each month. And of course, this is before any potential reduction for a survivor. Or the other calculation is 1% times 35 years of service is 35% times 75,000 for the average salary is, again, still the same, $26,250. Okay, so now we're going to look at the general formula. This is if a person is age 62 or older and has 20 years of service or more, they get that 1.1%. So the question was, an employee separates with 20 years and does a postponed retirement at age 62, do they still get the 1.1% calculation? My understanding is that, actually, now that I think about it, I feel like I've come up with this issue before, and the answer was no, they do not. Now that I'm thinking about it more, I am a little hesitant. I want to do some research on that one, and what I can do is, since I have everyone's email, I will send an email out to everyone that was in this class with the answer to that. Because yes, there is a BAL that came out last year on that. And so basically what it says is that we received some issues about if sick leave could be used to reach that 1.1%. And the short answer is yes, because I know in the prior few slides we said sick leave can't be used for retirement eligibility. However, in this scenario, they've already reached their retirement eligibility. It's already been met. So then at that point, the sick leave can be used to increase the years of service, which would then increase them to the 1.1%. I don't have the BAL written down. I believe it was in 2018, though, and I think we only had 2 BALs out that year. So if you just go to our BAL section, you'll go to 2018, you'll see it. Does the 1.1% formula apply to all 20 years, or just the years attained at 20? No, it's all the years of service. Once they've hit 62 and 20 or more, it's for the whole calculation. It's not like the law enforcement firefighters, where the cap is 20 years and everything else is then at 1%. I do want to add that for law enforcement firefighters and the congressional members and employees, they do not receive that 1.1%. So if they were to retire at 62 with plus 20 years, they would have the 20 years at the special provisions, but then everything else would be 1%. They don't get that 1.1%. So here's a calculation, and it's the employee is 62, and they have 24 years of service, and an average salary of $48,000. So you see here they get the, yes, there is one provision for air traffic controllers where they can get that 1.1%. And I believe it's something to do with their MRA in 30. That's something that's also will be updated when we're able to do the Service and FERS handbook for the law enforcement, firefighter, and air traffic controller chapter. Yes, thank you. It is that under the Vision 100, which I think was 2016, 2017. But yes, thank you. Not the standard ATC. They do not get that 1.1%. It's just that very small percentage or population that can actually get that 1.1% for air traffic controllers, and it's only them. So in this example, we see here again the calculation: 1.1% of 48,000 is $528 times the 24 years of service, and that's $12,672, then divided by 12. That is, and they do get, here's an example showing that they get the 1.1% for all of their years of service once they hit that 62 and 20 or more years of service. Or the other calculation is 1.1% times 24 equals 26.4% times 48,000 is $12,672, also divided by 12. And so the FERS Annuity Supplement is the benefit for FERS. And what it does is it substitutes the Social Security part of the FERS benefit until age 62. And it approximates the Social Security earned under FERS. And so it is also subject to an earning test. So I know the Social Security earnings limitation for this current year, I know its fiscal year will be over soon, is $18,240 a year for 2020. And so any FERS annuitant who is receiving a FERS annuity supplement will have his or her annuity supplement offset by $1 for every $2 over this earned amount. The annuity supplement payments are always based off of the prior year's countable work wages. So if an overpayment exists, if overpayment may exist if earnings match, we've got a branch that does the earnings match for the annuity supplement, is done after the 6-month year. If the retiree fills out the survey when they're received correctly, the supplement will be stopped, and then generally there will not be an overpayment. However, if that's not done, it's possible that there could be an overpayment for that. And to add with the earnings test, so for the individuals, the law enforcement, the special provisions, law enforcement officers, firefighters, air traffic controllers, they can earn as much outside of retirement and still keep their annuity supplement as long as they're under their MRA. Once they hit their MRA, they then, for anything that they work, they'll be then subject to the earnings test. Let's see. Social Security will allow for a prospective report of the current year's earnings. Will OPM ever implement this rather than a retrospective report? That I honestly do not know. That's potentially, but I can't say for certain if we will change that or not. Also, the annuity supplement is not subject to COLAs. And so, again, like I mentioned with the earnings test, the special provisions law enforcement officers, firefighters, air traffic controllers, they're able to receive their annuity supplement prior to their MRA. However, if you retire before you reach your MRA under an early option or discontinued service annuity, you have to wait until your MRA before you can start receiving the annuity supplement. Oh, thank you, Paula. Right there, so it's 5 CFR 842.43 addresses the question, and that is the 1.1% question. The employee must have completed 20 years of service and at least age 62 at the age of separation. So the postponed would not get them the 1.1%. No, annuity does not count towards the earnings test. I've seen, so when I was processing cases, I feel like most of the agency estimates that I saw, I know a lot of them were GRB. I think the other main one was the federal Navigator. There, oftentimes you would see the the estimated annuity supplement in the retirement estimate. And to continue on the annuity supplement, to be eligible for the supplement, employees must have 1 full calendar year of deductions under FERS. And so that is another thing. It has to be a full calendar year. So January 1, also for that year to be counted in the FERS annuity supplement calculation. So it has to be from January 1 to 12/30 of the calendar year to be included in the calculation. So I know a lot of times when an individual retires, if they were to retire 12/29, we carry over to 12/30, and that would not count. So it has to be 12/30 or 12/31 for our separation date to have that final year counted in the annuity supplement calculation. And again, an individual must qualify for an immediate non-disability retirement. Other than an MRA plus 10, that does not count. So they can't postpone. They do not receive the annuity supplement either, nor disability. And then the also just when it ends their 62nd birthday. So for retirement and Social Security purposes, an individual attains or becomes their age the day before, the first moment of the day before his or her 62nd birthday. So for example, would be if a retiree's 62nd birthday is on September 1st, then he or she becomes 62 on August 31st, and they would not receive that annuity supplement for the month of September. And so now we're going to look at the reductions applied to basic annuity, and it's there's only a few of them. Well, many variations, I guess. And that's the FERS age reduction, and that's only if there's a FERS component case. The MRA plus 10, and then the main one would be the survivor annuity election. So with the FERS age reduction, that's a permanent reduction that equals 2% for each full calendar year under age 55. And it applies to FERS annuities or FERS annuities with a FERS component. Let's see, when you receive your annuity, FERS annuity, and don't draw annuity count. That, so do you mean for annuity supplement purposes or for Social Security? That I'm not 100% certain about. That maybe you wanted to address that with Social Security. Thank you, Stephanie. Annuities are not work wages, so it wouldn't be included in the Social Security earnings calculation. But I guess that brings me up to the point that I've gotten this question in the past, that if they don't start collecting their Social Security at 62, can they still receive the annuity supplement? And no, that stops 62, whether they decide to receive the annuity supplement at 62 or not. And for the FERS age reduction, it applies if the employee retires on the MRA plus 10, and it's a permanent reduction and equals 5/12 of 1% for each full month under age 62, or generally, which is 5% for each full year under age 62. So that can really reduce the annuity. The employee can avoid the age reduction entirely by choosing a commencement date, either the day that is less than 1 full month before the employee reaches age 62, if he or she has less than 20 years of service, or the first day of any month after reaching age 60, if he or she has 20 years of service. And finally, the reduction for the survivor annuity. So this will apply if the employee elects a survivor annuity for a spouse, or through a court order, they have to apply it for a former spouse, which also the court order may, as well as the survivor annuity, may also be a garnishment on the annuity as well, or if they elect to provide an insurable interest annuity to an individual. And so the survivor annuity reduction under FERS is straightforward. It's either a full survivor annuity, which is 50% of the annuity, and it's a 10% reduction on the annuity. A partial is 25% of the annuity for the survivor, and it's a 5% annuity reduction. And so just some things with this, I guess more so for post-retirement. If an annuitant was not married at retirement and they get married later on, they have must receive this, OPM must receive from the annuitant a signed election within 2 years of the marriage in order to process the survivor election for a post-retirement spouse. And the deposit has to be collected in an actuarial reduction instead of just a deposit or lump sum payment. With the insurable interest, it's a person who has a reasonable expectation of life, financial benefit in the continued life of the annuitant. The reduction, depending on the age between the annuitant and the insurable interest, it ranges from 10 to 40%. So if it's a younger potential child, it would be close, if not 40%, closer to 40% reduction. And in order to have an insurable interest, the retiree must be in good health. It cannot be a disability retirement, and they must include medical documentation with the retirement paperwork package showing that they're in good health, and this has to be from a doctor. They can't just type up a letter saying that they're in good health. The retiring employee may only elect one person as the beneficiary of the insurable interest. OPM will not accept designations of beneficiaries, and the designation would be void if that were to happen. And it has to be done at retirement. There are no post-retirement insurable interest elections. And generally, an insurable interest, it would be a current spouse, a former spouse, a blood or adoptive relative closer than first cousin. Another would be a common law marriage, in another potential insurable interest. And then finally, we're going to look at the last few slides, is the reemployed annuitants. So generally, the annuity continues and the salary is offset by the amount of the annuity. Of course, there are some exceptions, and that's disability annuitants and dual compensation waivers. And under FERS, a retiree's annuity is only terminated in reemployment when the annuity is based on a disability and OPM has found the annuitant recovered or restored to earning capacity. As well as the other provision of this is a disability annuitant who is not disabled for the National Guard technician position, but were awarded disability annuity because they were medically disqualified for their membership under the National Guard. That's another where the annuity would be terminated. And some other things is that if the appointment is intermittent or covered by another retirement system, the retirement deductions will not be held, and they would not get credit for that in a potential supplemental annuity or redetermined annuity. And again, with the dual compensation waiver, that is where they're receiving their annuity and compensation, but they do not get any credit for that service in a supplemental or redetermined annuity. The cost of living adjustments, they're generally not applied until December after age 62. And the exceptions of that are the disability, which COLAs are not payable on a disability annuity during the annuitant's first year on the annuity roll if the rate is based on that 60% of his or her average salary. If an annuitant is removed from the roll for recovery or restoration to an earning capacity, he or she is restored at the 60% rate for a year and not eligible for the COLAs for that year either. And then the law enforcement firefighters, they get theirs before the 462 law enforcement firefighters and air traffic controllers. Survivors, former spouses, and insurable interest all get their COLAs as well before 62. Are there any additional questions? Oh, sorry. The last slide is just talking about the cost of living adjustment, and it's the percentage in the CPI. It's 0 to 2%. COLA equals the CPI increase. 2 to 3% the COLA equals 2%. Over 3% the COLA equals the change in the CPI minus 1. And I know for 2020 the COLA was 1.6% for FERS and SERS. Yes, this webinar is recorded, and so it will be available on the registration site. My understanding is that they will all of them going forward, I guess everyone in this month-long training will be recorded that you can view later on. Yes, generally the COLA is not until age 62, December after age 62 for the majority of FERS retirees. Did you not receive the slides? Should have been included in the link to. Yes. Okay. So, okay. Question: are you saying that if an employee retires at age 60, they will not get a COLA for 2 years? Yes, for FERS, except for those few exemptions, they do not get their COLA until December after age 62. Is there any indication that there will be a buyback for years worked as a seasonal employee? I guess, are you referring to, was it FICA non-deduction service? It would be, if it's prior to 1189, yes. If not, I know there's been some talk where they're trying to or want to make it possible that FERS non-deduction service after 89 could be bought back, but as of right now, it's just talk. There's not been an official proposal, or to my knowledge, or that's gone through the House or Senate yet. If that does change, of course, we would put guidance out and issue. Okay, so they did get so they did get a bill on the floor, but yeah, I do believe, because I haven't heard anything yet, and obviously that would be huge news at OPM. So yeah, I think now it's just in talks, nothing concrete, or it has not moved forward yet. I have a question on the annuity supplement, however, it's a long question. That's fine. Also, if it's very detailed, it may be best to send it to your liaison. What agency do you work for? And are there any other questions? Okay, DOD, Michael Evans is the liaison for DOD. So you can send it to him, or you can send it to me as well, and I can take a look at it, or potentially forward it to him. Oh, thank you, everyone. I guess if there's no other questions, I guess the class is done for the day. And I believe we have a class tomorrow. And again, we will have 3 classes. I think there's 2 weeks where there's 4 classes. Again, the last week is September, the first week of September. So it's a month-long training event again. And thank you, everyone. I hope you have a good day, and I hope everyone is staying as safe as they can in these times. All right, thank you.